So most people know about investing and about the importance of investing their money. However, there's a lot of information out there when it comes to investing and a lot of routes that you can take when it comes to investing your money. A lot of beginners may not know where to start, what to invest in, or what to even look at when it comes to investing. So in this video, I'm going to go over the basics of investing and one of my investing strategies that's very simple but effective for beginners that I use currently today. So welcome back to another video, guys. Today the topic is investing. Now, investing in the simplest level, in the simplest form, is when you, in terms of the stock market, is when you buy part ownership or equity in a company or a series of companies in hopes that the company will later give you return on your investment. Now, you buying shares from a company or equity from a company does not necessarily mean that you can, walk into Jeff Bezos' office or walk into Bill Gates' office and start making decisions for the company, but it does mean that you are either betting that the company is going to do well and in turn you're going to receive some money on your investment, or in some cases for more advanced investing, you're betting against the company that it'll do bad so you can get money that way. Now, one of the reasons why investing your money is important is because leaving your money in a bank account just sitting there is not good. Now, most people have the fallacy and they believe that leaving your money in a bank account is a good thing because you're saving money. Now, this is a fallacy for two reasons. One is because of inflation increasing for about 2% year over year, and two, from the low returns that you receive from bank accounts. Starting with inflation just basically means that the price of goods go up over time. So if today milk costs $5, in a year or so milk is gonna cost $5.50, which basically means that your dollar today that you could spend on $5 milk is worth less than what you could spend on milk in the future, because now the prices are higher, but the value of your money has stayed the same. Now, the second reason why investing is better than leaving your money in the bank account, like I said, is because of low returns on bank accounts. Most bank accounts are giving you 0.00% on your money through dividends, and this is nothing compared to if you could put your money to work in assets or real estate or investing that returns on average between like 6 to 10% per year. Couple that with inflation and low returns, your money is basically losing its value over time in a bank account. So that's why it's important to take your money, most of your money, out of the bank account. Not all of it, because you need money for a rainy day or emergency, so you need some cash on hand, but most of your money should be put to work in investing. Now, in terms of stock investing, which we'll focus on in this video, there's many ways that you can make money in stock investing, from short-term gains to long-term gains to day trading, swing trading, long-term investing, shorting, and many other ways to make money investing in stocks. Now, also within that, you have options to choose from to what you want to invest in specifically. Now, this could be stocks from companies, this could be bonds, this could be ETFs, index funds, or cryptocurrency. So now most people are familiar with stocks and cryptocurrency, which is a hot topic nowadays. So with stocks, you can open up a brokerage account today. You can go buy shares in Apple, you can go buy shares in Disney or Amazon. You make money from either the price of the stock going up or from the company paying you dividends. Now, like I said, there are other ways you can make money from stocks, but we'll just focus on growth for this video. So the price goes up and I sell at a higher price than I bought at, then I make money. If the company gives dividends, which is basically the company is paying you for owning their stock, then that's another way you can make money. So the same concept applies to cryptocurrency, in that you buy crypto in hopes that it goes up. If you sell it at a higher price that you bought it at, then you make money. Now, so when it comes to choosing stocks to buy, you have pretty much two types of people. You have the emotional investors and you have the technical investors. Now, emotional investors are the majority of people who just buy stocks based off of feeling. If you like Apple products or you like Apple as a company, then you just buy Apple stock because of that. People that follow social media or trends or hype, you buy stocks or crypto or whatever because other people are telling you that it's something good to buy. And this type of investing can make you money, but most of the time it does not make you money, because people that rely on other people's information when it comes to buying or trading stocks or any other types of assets don't do their own research, and then they get punished for it because maybe the person that you are following wanted the stock to go down but was acting like they wanted it to go up, and you're following other people's games and not doing your own homework, and that is what's going to result into a lot of losses and a lot of people losing their money in the stock market. So now, second, you have the technical investors, and these are the people that are looking at charts, studying financial statements of companies, and studying the company overall and making their decisions based off of numbers. Now, this is probably more an effective way to make money in the stock market or whatever assets that you want to invest in, but it is a lot more time consuming in that you have to literally day in and day out be watching the market, be studying companies, and make sure you're keeping up on latest trends. And most people that are beginners or doing this, part-time to make some money or create financial wealth for themselves, don't have a lot of time to really watch companies and watch stocks as much as people that do it full-time. So now one of the big reasons that I'm making this video is to talk about, the happy middle ground that you can have between being a technical and an emotional investor, and that's in investing in index funds. Now, most beginners and most people that are just getting into the stock market don't really know about index funds. They only know about stocks, individual stocks. Now, so basically what a index fund is a fund that has multiple stocks from multiple companies housed into one fund that you can buy. Now, for example, one of the most famous index funds there are and that most financial advisors talk about is the S&P 500. The top 500 companies in the US bundled into one index fund that you can buy. Index funds are good because, one, they are low cost. When you buy and sell stocks, you have to pay not only capital gains taxes, which is getting taxed on the money that you make from the stock, but also you have to pay commission to brokerages that can range from 1% up to 10% when it comes to buying and selling stocks using their platforms. So index funds are very low cost. Most index funds are low cost. The higher the cost, the more it eats away at your profits. But one of the biggest reasons why index funds are good is because of diversification. You'll hear diversification a lot when it comes to stocks and portfolios and people mentoring other people on investing. Now, diversification basically means don't keep all of your eggs in one basket. Now, most people that buy individual stocks, if you just bet all of your money on one individual stock, say for example Apple, then you have no cushion if Apple does well or if Apple does bad. So if Apple tanks and all of your money is in Apple, then all of your money is going down. Now, with index funds, diversification in that sense is you spread your eggs to multiple companies. Now, if I have an index fund, I own multiple companies, and if one of the companies in the index fund is not doing as well as the other companies, then usually that balances out because companies do well at certain times and other companies do well at other times. So I won't have to worry about one company crashing because I have my money spread out among the others. Now, it's also easier because now you don't have to do as much research about each individual company because they're all housed into one big fund. Whether you were gonna buy individual funds, say for example Apple again, you would have to research their financials, look at their charts, find when a good time to buy is, find when a good time to sell is. But with index funds, you don't have to do as much research because you have the cushion from the other companies. And if you're using standard index fund like the S&P 500 or the NASDAQ, which house the best companies, then you won't have as much risk from having this index fund versus having individual stocks. Now what's also really good about index funds and long-term growth investing is that you don't have to worry about selling the asset. So like I said before, you get taxed when you buy and sell a stock, and you also have to pay the brokerage a certain percentage when you sell the stock. Now, if you just buy the stock, you don't have to pay any money until you sell it. So the idea with long-term investing is that you buy the index funds and you hold on to them for years and years later, and you can transfer the portfolios and those investment accounts to your kids so they don't even have to sell it, and you can keep holding on to the money. So what this helps with is basically having a hands-off approach where you just buy the index fund, more of it each month, and you just let it grow in the long term, and you don't have to worry about watching it every day. You don't have to worry about if it's going up or down like stocks do. You're more focused on the long-term gains and not the short term. And this sort of balancing act between your main account of long-term growth and your riskier short-term investments is almost like a cheat code, because it's like, okay, I can risk making mistakes in business, or I can risk making mistakes in my riskier accounts, and that can make me a lot of money quickly, or I could lose a lot of that money quickly, but I'm good because I know that I have my long-term account, and I know that's going to guarantee me financial freedom in the future. So it's like I can fail today, but in the future I know I'm going to be good. So you can take more risks now, and it still gives you the chance to take advantage of, you know, things that can make you money very quickly. So now a lot of the standard index funds are pretty expensive. So now what people do and what I do is people buy what's called ETFs. Now ETFs are like index funds, but they're smaller and they're cheaper to buy. So VOO is the ETF for the index fund of the S&P 500, but it's cheaper to buy. It's still the same companies within the S&P 500 index fund within that ETF fund. So ETFs also have different industries that you can buy into, whether that's healthcare, whether that's technology, and these are also index funds, but within certain segments. So index funds can be used from the best companies within the stock market, but also within specific industries that you are maybe interested in investing in because you think it'll do well or because of the times that we're in now. So now if you just take advantage of that slow growth and you also take advantage of compounding interest like I talked about in my previous videos, then in the long run you can basically guarantee yourself financial freedom, because of history has shown that over time the overall market and the index funds always outperform individual stocks and always do well year over year. So now one of the best books that I read that goes a lot deeper into, you know, index funds, long-term investing, and basically guaranteeing yourself financial freedom in the future is the little book on common sense investing. Now this book was very short, but a lot of the information in it is very powerful and can help give you more information on investing, long-term investing, and making smarter investments. So I would recommend you giving that book a read, and also, like I said, doing your own homework when it comes to investing and learning about investments. Don't just take my word for it or anybody else's, but make sure you gain your own information so you can make your own decisions and have your own opinions when it comes to your investments, because at the end of the day, it's your money. You should be the only one that knows what you should do with your own money. Check out my previous videos where I talk about, you know, goals, investing, and my routines that help me keep track with my investments. Stay tuned for more videos on investing in the future. Make sure you like, comment, and subscribe on the video, and I'll catch you guys in the next one. Peace.